Now we're going to talk about significant changes to a corporation. Here are examples of changes, right? These fundamental changes, we mentioned them earlier. These are significant events that can alter the structure, operations, or ownership of a corporation. These changes often require shareholder approval to ensure that the interests of the shareholders are protected. Some of the most common fundamental changes that are going to require shareholder approval are going to include one, we got mergers and consolidations. So we combine two companies, that's a merger. One corporation survives, the other cease to exist. Consolidations, they create a new corporation while the original corporation ceased to exist. Now, shareholder approval is required for both mergers, consolidations, acquisitions, anything like that. That's going to be important because these can significantly affect the ownership, control, and value of the shareholders' investments. Compulsory share exchanges. Well, a compulsory share exchange occurs when a corporation acquires all the outstanding shares of another corporation in exchange for its own shares, securities, or other consideration. Shareholders of the acquired corporation must approve the exchange as it is going to affect their ownership interests. We've got dissolution. Well, this is the process of winding up, which I would say, again, I've kind of mentioned this before. I would say it's more so, sounds like winding down. But yeah, winding up the affairs of a corporation, terminating its legal existence. Shareholder approval is required because dissolution directly impacts the value of their investment and the future of the corporation. Yeah, someone shutting down my investment, I probably want to say in that as well. Any amendments to the articles of incorporation, that is fair as well, changing essentially the founding documents of the entity. That again, I think that sounds pretty fair. The structure, the governance, any significant amendments to the articles of incorporation, any materially impactful changes for sure. Then sales of substantially all of the corporation's assets outside the regular course of business, right? If we're dealing with Lowe's, if someone wants to sell all of the physical locations or all the inventory or sell off all of the gardening equipment that Lowe's sells, that would be a sale of a good amount of all of the assets outside the regular course of business. Shareholder approval is generally required when a corporation sells or transfers a significant portion of assets outside the ordinary course of business. Someone buys Burger King and they want to sell off all of the ice cream machines, that would be significant as well. This approval is necessary because such transactions can fundamentally alter the company's operations, financial stability, or future prospects, which can impact the value of shareholders' investments. All right, maybe not the ice cream machines because they can still sell burgers and everything else. We're not going to get into the nitty-gritty and actually go through details or examples. Now, in each of these situations, obtaining shareholder approval is going to be essential to protect the rights and interests of the corporation's owners. The approval process usually involves providing shareholders with relevant information, holding a shareholder meeting, and obtaining the necessary vote or consent to approve the proposed change. Now, when we do have a significant change to a corporation, what does that process look like? Overall, we want to get an idea of what we're dealing with. Now, we have specific procedures in place with corporations for making decisions and implementing those changes, especially when it comes to those fundamental corporate actions. These procedures typically involve board resolutions, notice to shareholders, shareholder approval, hopefully, if it's a good decision, hopefully the shareholders approve it, and then the right to dissent or exercise appraisal rights. Here's a general overview of the process. So let's just, with all of this, discuss, let's say, a major selling of shares to, let's say, a new shareholder, or a major merger or acquisition. Think of something like that as we run through these 4 points. Now, first, the board resolution. The first step here is usually for the board of directors to pass a resolution, kind of just like a governmental entity saying, here is a bill. Let's see if it passes, through Congress, through all that. This is the general idea of what they want to get done. The board's going to discuss and evaluate the proposed action, considering its impact on the corporation and its shareholders. If the board determines that the action is in the best interest of the corporation, they're going to go ahead and adopt a resolution that approves the proposed change. Next up, we're going to give notice to shareholders because we can't just immediately the next day ask for shareholder approval. Nope, we have to give notice to shareholders once we approve the resolution, giving them time to discuss it, talk maybe with their legal counsel, to maybe sell out of the company, whatever that may be. We want to give notice to the owners, the shareholders of the company. Corporation must provide notice to all shareholders about the proposed action. This notice should include relevant information about the action, such as its purpose, potential effects on the corporation and shareholders, and the rationale behind the board's decision. Why are they doing this overall? You kind of want to get an idea, hey, is the board of directors maybe crazy? The notice should also inform shareholders of the date, time, and location of the meeting where the action will be discussed and voted upon. If you're a fan of a wonderful show on HBO like me called Succession, you'll know that there was a scene with a board meeting that did not go like this at all. It broke every process, and I have watched that scene and said, hey, there was a lot of things that happened there that do not follow this process. Well, that's because it's TV, not real life. And me, as someone who records these lessons, watches that scene and goes, oof, that is just not how things would work in the real world. But love the show anyway. Wonderful show. Now, for many fundamental corporate actions, shareholder approval is required. During the shareholder meeting, shareholders will have the opportunity to discuss the proposed action, ask questions, and express their opinions. Shareholders will then vote on the proposed action, typically based on their ownership percentage in the corporation. The action will be approved if it receives the required number of votes as specified by the corporation bylaws or any other applicable laws. Lastly, we've got the right to dissent or appraisal rights. Now, in some cases, shareholders may disagree with a proposed corporate action and believe that it negatively affects their interests. Hey, find me an action that everyone's going to 100% vote on, and I'll call you crazy because it does not exist. No one's going to agree on absolutely everything. Now, is it a majority that dissents? Is it a minority? Is it just one or two people? Is it pretty much everyone, right? What is that going to be? This applies in all those situations. These shareholders have the right to dissent and then exercise their appraisal rights. Now, dissenting shareholders can demand that the corporation buy back their shares at fair value, basically saying, I want to get the heck out of here, buy my shares back, I want out, I'm cashing out, which is typically determined through an appraisal process. Now, to exercise these rights, shareholders must follow specific procedures outlined in the corporation's bylaws or applicable laws, such as providing written notice of their dissent and submitting their shares for appraisal. Now, this process is there for the benefit of the shareholders. Just in a nice wrap up here, this is not going to be something where you need to memorize the process. A lot of this lesson also is to just build a good fundamental understanding of these entities and everything that is going to come with them. Good familiarity with all of this process, but you don't need to memorize step 1, step 2, step 3, nothing like that here. All right, terminating a corporation. This is important. This is how we are going to end a corporation. Now, you could just decide to end a corporation. Normally, you actually don't see that. I've watched a lot of documentaries on corporations that should just be ended because there's no way to continually get value. I mean, hindsight's 2020, but at a certain point, whether it's Blockbuster or any Kodak or companies that have sort of legacy products that probably are not innovating enough to stay alive, it would make sense to dissolve them. However, because of money, because of the real world, because that's a hard decision to make, and who wants to make hard decisions, am I right? A lot of these companies that, again, probably should have been dissolved are not. And it's rare that you'll see just a normal big name company dissolve itself and terminate on its own accord rather than just keep going until it faces bankruptcy. Many reasons for that as well. A lot of money in bankruptcy. There's a lot of lawyers that want their chunk of change and a lot of executives that will just keep going as far as they can, kind of suck the company dry. But if a company acted in the best interest of shareholders all the time, many times you'd see companies actually end because they determined the price of the shares went up a lot, the company's valuable, and when they're at their peak, it's kind of like you want to sell your shares of a company when it's at its peak. So too, would the company at its peak want to maybe dissolve operations, right? They see that there's not really any way forward. That's just me giving my little spin on all of this. Now, talking about terminating corporation dissolution, this is a fundamental change. Obviously, as we talked about, marks the end of its legal existence. It requires the approval of both directors and shareholders and can also occur as a result of a court order. Common reasons for dissolution involve bankruptcy, reaching the end of a corporation's specified lifespan, or by mutual agreement of shareholders and directors. Again, generally speaking, it's going to be through bankruptcy. You're not going to find anyone taking the action to close down a company because then you're going to be the one to cut off potential future profits, right? You don't want to be that person. And the unknown is something that we are afraid of. And if you close down now, you might not make money in the future. Again, that's kind of why. But if you keep going, at least you'll know that the company eventually went bankrupt and that was all it could do. Now, winding up in liquidation, following dissolution, the corporation continues to exist for the purpose of winding up its affairs. As I was told by my mother, become an accountant because guess who the last one they're going to fire is the accountants. You need accountants all the way until the company is fully bankrupt. So even when times get tough, you're still going to have a job and embody that information and that mentality yourself. You are in a pretty safe industry overall. This process involves collecting corporate assets, paying expenses, satisfying creditors' claims, and distributing the remaining net assets to shareholders. Now notice here the term net assets, right? If we think of the accounting equation, assets minus liabilities equals equity, and you're saying to me, Nick, you're crazy. This is the reg exam. Why are we talking about that? Hey, it's good to tie it all in. Net assets, again, you could also rephrase that equation to say assets minus liabilities equals equity. And another name for equity in that point would be net assets. So whatever's left, the value gets distributed to shareholders once all the liabilities are paid down. The aim here is to ensure that all outstanding obligations are met before the corporation ceases to exist. One individual I talked to on a tour of Bloomberg This was many years back. Said, yeah, stocks are hot, right? It's fun. You think equity, want to get involved in options, derivatives, calls, puts, all that good stuff. Where the real money is debt. Debt, there's a lot of money in that. And being involved in the financing process through debt with bonds, with bankruptcy, you are the one to get paid first. So it's something, if you are ever interested in the industry, debt is a way to go. All right, let's talk about the calendar versus fiscal year end for a company. You might think a company just, yeah, they run the year from January 1st to December 31st. And in some cases they do, in some cases they don't. This is also a point that we'll see as we dive into the various other lessons, whether it's S Corp, partnership. We're going to see points on which you have to choose a certain year end, whether that be calendar or fiscal year end. We'll see with partnerships, not that we really talked about it here, that'll be more within the partnerships lesson, where you may have to align your year end for the partnership with a majority partner. So different rules for different entity types. Here, corporations can choose between a calendar year end ending on December 31st or a fiscal year end ending on any other day other than December 31st. Now, a calendar year end aligns the company's financial reporting period with the calendar year, while a fiscal year end allows the company to select a different 12-month period for financial reporting. For tax purposes, the IRS must approve the choice of fiscal year. What are some examples of this? Well, let's think of accounting firms. I know that when I worked in the Big Four, we had a year end of 6/30. And why is that? Well, because if you're auditing, doing tax, if all of your clients have a 12/31 year end, you probably don't want to be aligned with those clients. You want to have a different year end, be able to close out your books when things are slower. That's a great example. Another great example, Spirit Halloween. Gotta love how they just come back, sneak up, and take over all of those empty department stores when Halloween comes around. A lot of companies that have their business specifically around significant points, such as Halloween, may have a different year end. So it just depends on what your business model is and what is beneficial for the entity. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.